Awesome. So, first off, tell us a little bit about yourself, Kelly. What about your company, Credit Resources of Washington, and how you help people with credit?
Okay, well, I was a mortgage loan officer for 9 years before I started doing credit repair. And I actually did some credit repair and did mortgages still for a little bit of time. It overlapped. But I started doing credit repair because my doctor told me I had to get out of doing mortgages, that it was too stressful. So I started really pursuing credit repair because you kind of did it anyway to live. I mean, when you're a loan officer, you're trying to figure out how to make these loans close one way or another. And so I just stopped doing mortgages and went into doing credit repair because I enjoy helping people. I enjoy that end of the line where they get that new home, they get their dream house, they get their new car, whatever it is, they're excited, and you can walk them through that process. And as long as they're willing to listen and do what they need, we're good.
Full
So credit
disclosure,
resources. Well,
I am
what was
a,
that?
I was just going to say, full disclosure, I am a client of Pro, just so whoever watches this knows that. And I have obviously seen positive results from using your company and the responsiveness, and it has helped me accomplish my dream. I'm now pre-approved, and so now I can look
Yes.
for a home.
Nice. That is so exciting. Yeah.
Yeah.
Well, and also so that people understand, you don't have to have, really bad credit to be a client of Crow. You maybe you just need, I get calls where lenders just need 2 or 3 points. So it's not a matter of anybody that's my client just doesn't know how to pay their bills. That's not the case. Everybody's situation is a little bit different. And so, don't think that just because somebody is working with me that they've got really, really bad credit, because a lot of times they do not. They just need some guidance.
And good credit, bad credit is so nebulous because there's so much information, right, on the web that we say, okay, well, what is good credit? And
Right.
so that leads to my next question. There are a lot of myths about what it takes to build credit. Could you just spell just 3 of those myths?
I send out emails to my clients, kind of educational emails along the way. And there are myths out there that people really, they don't understand. Like, one of the myths is that all the credit bureaus should have the same credit score. And that's not a true statement, in that each of the credit scoring models has their own model that they score off of, which they're all pretty much alike, but they all have a model. And not everybody gets all of the same information. So just because TransUnion has all of these files, maybe you have a collection on your credit report that only goes to TransUnion. Somebody that reports credit to the bureaus, all that the law says is that if they report one person, they have to report everybody that pays them money. They can't pick and choose who pays, but they can pick and choose who they pay their money to, because the bureaus charge these people that are reporting. They charge for everybody that they send into them. So the credit bureaus have a really sweet deal going on. They get paid from us as we pull our credit. They charge us, but they also charge for the creditors sending their information in. So, smaller companies don't report to all 3 bureaus. And also, small companies can't report at all. Like, I can't report because I'm too small. You have to have a fairly large number of people going, paying you money in order to even get on the ranks. So to go back, not everybody gets the same scores across the board. Very rarely do I see scores across the board being the same. So don't panic. I mean, and I even see sometimes where Equifax could be 100 points lower than TransUnion or Experian, and it's because Equifax is who has all the collections. So that's one myth. Another myth is that if you close old credit cards, that's a good thing to do, is to close credit cards. And you don't want to close old credit cards. The only time I advise a client close an old credit card is if it's a credit card that they are paying, it has a yearly fee. Like when you're first building credit, you can get a credit card that is, it costs $39 a year, or it costs $75 a year. And you've built credit and got other credit since then, maybe go ahead and close that card. Closing old credit cards, you don't want to close those credit cards even if you don't use them. If they're not charging you, and let's say you only use it once every 4 months to keep it active and then pay it and don't get charged any interest from it, you're going to get the history of that credit card. So you're still going to get that even if you close it, because once it's history on your credit score, it's history. But the utilization, if you close a $1,000 credit card and it's paid off, you just lost $1,000 of your utilization on the other credit cards. Or if you close a credit card, or they close a credit card on you and you owe $900 out of that $1,000, now it's going to make your utilization even worse, because now you don't have that you don't have that to buffer from. So the only time I suggest closing a credit card is if it's costing you money and you've got plenty of other credit and it's not going to harm you. Another myth, I want to build credit, so I got a new credit card and I got $1,000 limit, let's say, and I charged $900 on that credit card, and now I'm just going to make the minimum monthly payment so I can show that I know how to make payments. It's going to help me build my credit. That's not what you want to do at all. If you never want to charge more than 70% of the available limit and leave it there. You want to, because once you leave more than 70% on that credit card, the scoring model is going to ding you like you've made a late payment, even if you're not making late payments, because it thinks you're living off of credit. And so because it thinks that, it wants to slow you down. And so you want to always make sure you're below 70%. And if you can, the really sweet spot to be is below 10% of your credit. So if you're below, if you have $1,000 limit and you keep it below $100, you're going to get the best possible increase in your score that you can. So, that's definitely something that I would suggest. Is if you can, pay your credit cards down to below 10%. And if you're trying to build credit, it's okay if you just go out and buy a tank of gas or buy a package of socks and pay that bill off when it comes. You don't have to be paying interest. You just want it to see that you're using it. And you can use it once every 4 months and keep it active and still be okay.
So just to repeat the 3 myths real quickly, there's no need to close old credit cards because the length of time actually helps show that you can establish credit and build credit.
Right. Each bureau gets different information. So your scores aren't going to be the same across the board. And then the other, not to max your card out and just make the minimum payments.
Those are great tips, obviously, for anybody wanting to buy a car or wanting to get any type of credit, because obviously we live on credit in this country in terms of establishing a type of record that helps us qualify for loans, whatever those loans might be, right? So just to roll down the next question, how does bad credit affect people who want to buy a home and also in other areas such as buying a car or renting, for example?
So the whole purpose of the credit scoring model was to see who's going to go 90 days or more late in the next 2 years. So when you have bad credit, the lender is looking to see, are you an okay risk? Are they safe in lending you money? So by having bad credit, if you've got recent late payments, they're kind of going to question whether they should lend you money. Now, I have a chart that I do when I do my classes. So what it tells us is if you have the odds of going 90 days or more late, if your score is above 800, the odds are 1,485 to 1. So they don't have to worry about you going late. If you have a credit score between 680 and 719, the odds are 112 to 1. So they drastically changed. And then if your credit score is below a 620, the odds are 15 to 1. So when I'm doing a class, there's usually 15 people in that class that I'm talking to. I will say, if I'm a lender and I'm trying to give somebody credit, I'm deciding if I'm going to give them credit, out of the 15 of us, one person I'm going to be chasing for my payment. So they don't want to have to chase. And so if your credit score is below a 620, you understand now why it's harder for you to get a loan. Why you want your score up above 680 or, up in that upper range, because then they don't have to worry about it.
What is considered then a good credit score? Obviously, every company, right, has its own algorithm as far as what risk they're willing to take depending on their investors, I imagine. So for a house, what's the difference between a house credit score or the purpose of building credit to buy a house versus the purpose of building credit to buy a car?
So it's really funny. The FICO scoring model, which is what almost everybody uses for giving credit, there are over 20 different scoring models. So credit cards have their own scores, car lenders have their own scores, mortgage people have their own scores that they look at. And so when you're trying to buy a house, you can buy a house if you've got a 620 credit score. A couple months ago, they would go down to 580, and there still are some lenders out there, but they're harder to find. So they will go down there, but you're going to pay a higher interest rate when you have those very low scores. So you want your score to be up there. Car dealers, we need cars, and people have bad credit. Things happen, and car dealers will give you do a car loan for you if you've got a score in the 600s, below 500s, but you're going to pay a terrible interest rate. If your score is really low, in the high fives to get a car loan, you're probably looking at 16% interest. And car dealers will go up to over 20% interest. You're never going to pay that car off, which is really sad, because it's the people that need it the worst that pay the most credit, the most interest. And so when you think about what is a good score, if you're just talking about a good score across the board, an upper 600, low 700s is where people are like, yeah, you've got a really good score. In the 600, 660, you're getting there, but you still haven't shown the length of time to be at that 700 mark yet. So you really want in the 700s. Now, the scoring model also, you don't want an 8. Not that you don't want an 820 credit score or an 850 credit score, but lenders will also question giving you credit, brand new credit cards, just like they do the people with lower credit, because they know they're not going to make any interest off of you. You're going to go out, you're going to use their money, and you're going to pay them back immediately. So you're never going to get a late fee. You're never going to get an over limit fee from these people. I talked to a guy from Cabela's at one time, and he told me, absolutely, we don't like those people in the 800s. We want them in. The people that are our sweet spot are the people in the low 6s, because we know they're going to push the credit limit. We know they're going to go over limit, or they're going to go past due a couple times, but it's okay. They're going to pay us, but we're going to make money off of them. Wow. It's a business.
That's just mind-blowing to me. It really is. It makes sense in the sense that, okay, they're for-profit companies, but I didn't think that the behavior based on their credit score, it can imply if it's too good to be true, then they're not going to make any money, like you said. And if it's too low, then they're not going to make any money either, because they're not sure if they can actually pay them back. Yeah.
Right. And I wouldn't, I mean, personally, I wouldn't not get that 840 credit score, that mid 800 credit score, because if your credit's that good, you really don't need that credit card anyway, more than likely. So I mean, I wouldn't let that deter you from making that be your goal, but just know that there are times that you're not going to get a credit card because of it.
We talked about this quite a bit as far as the different scoring models and the difference between building your credit for the purpose of buying a home versus other goals such as buying a car. And you mentioned each company has their own different scoring models. Can you elaborate a little bit more on that? There's 20 different scoring models you mentioned.
So when they're looking at those scoring models, a car dealer is going to be more interested in if you have ever had a car repo, or you've been late consistently on your car payment. Whereas somebody giving you a credit card, maybe the car repo isn't as big a deal. So you're going to have a little bit higher score with a credit card company than the car dealer, than the one that the car dealership is using, because you had a repo. So that's that. So it's not that they're looking at different information, they're just weighting the information and the scores differently.
And so every company has a different algorithm, no? I mean, is that what you call it? Each of their models? Okay.
Right. And so that is also why I know almost everybody has looked at a credit report that they pulled off of online, gotten a personal credit report, and gotten a Vantage score. That's what personal credit scores are, unless you go to FICO and get a score that is said that it's a FICO. So a Vantage score weights things way different than FICO. And what I started to say was, and that's the reason you don't see a lot of lenders using Vantage scores, is because these big banks like Wells Fargo, Bank of America, they have algorithms that are vetted very, very deeply throughout all of their banks and places that they've made tweaks to in FICO that it would cost them hundreds of thousands, if not millions of dollars to change and to go over to Vantage. Wow. And so that is a lot of the reason there's the pushback from changing and using Vantage scores.
Do you think Vantage score has the best scoring model, or is that just one of many models?
Well, no, it's not one of many models. There's not a lot of FICO they pretty much had the domination of the market. They had no competition. It was FICO, Fair Isaac and Company. They're the ones that created the algorithm, and they had it. And Vantage is coming in trying to say, hey, we want our fair share of the market. And they've been working on it for quite a few years now, and they're getting closer and closer to the bigger companies starting to use Vantage. And I really think it needs to happen, because you don't want one company.
Sounds like a monopoly.
They have a very big monopoly. And Vantage scores are a little different. Like a FICO score, if you have no score at all and you start your credit journey, it takes 6 months of having an open and active account before you get a credit score with FICO. So day one, 6 months later, now you pull your credit and it says, okay, now you have a score. When you look at Vantage, as soon as you open that credit card, the next month you have it. I mean, the next time it reports, you have a credit score. Mm-hmm. So there's differences. They say, well, how can that be predictive of what the client's going to do if, next week they now have a credit score because they opened a credit card? So there's reasons that they doubt it, but Vantage is showing that their scores they're pretty consistent with what they need to say.
Well, is it expensive to build credit? I think you touched on this earlier as far as the myths that you don't need a whole lot per se. Even if you're approved for $1,000, you shouldn't be spending $1,000 on that credit card.
Right. Yeah, it doesn't have to be expensive to build credit. You just have to know how, what to do and what steps to take. If you can't get a credit card at all, you got declined, you can go out and get a secured credit card with the bank. And a secured credit card would mean you would give the bank $200. They're going to hold that money for you. And when you charge, you're still going to pay it back. That $200 isn't used to make payment. You're still going to pay them. So you've got to have a little bit of money to do a secured at the beginning. The same thing, KeyBank, I believe it is, will do a secured line of credit because you need to have different types of credit. So KeyBank will do a secured line of credit for you where you give them, let's say, $1,000, and then you make payment on that $1,000. But when you're done with your payments in a year or however long you do this, now you have $2,000. So now you just did a savings account for yourself. So it's not that it's expensive, but depending on how you do it, you have to have a little bit to be able to work with for building credit. But no, it's not an expense. You can do it with no money.
Yeah. And oftentimes there's the myth too that you have to buy a car in order to build credit. And obviously you just dispelled that myth throughout this conversation that you don't need a whole lot of credit. What you need is maintenance of the credit cards one has, or even just one additional credit card. How many trade lines would you say is the ideal number of trade lines?
Right, so that's what I was just getting ready to say. So what FICO is looking for in its scoring model is it's for this 850 credit score. It's looking for you to have a mortgage, one installment loan, and 3 to 5 credit cards. So the installment loan can be what I just talked about by having the secured through KeyBank. It can be as small as $500, whatever your installment loan is. It does not have to be an automobile. 3 credit cards. I mean, you can have 3 $300 limit credit cards. If that's what you can get. And Capital One is very good about giving brand new people a very small card. And then they will increase your limit incrementally. And things to remember about building credit with credit cards is never go a penny over limit, never go a day past the due date, and Capital One will raise your limit. It'll go from 300 to 500 to 750 to 1,000 to 1,250 to 2,000 to 5,000. They just keep raising it as long as you never do step over that line a little bit. And
so
just because you get a $5,000 credit card, doesn't mean you need to go out and spend $4,500. That's just for a rainy day like today.
Yeah. They're looking for behavior, right? More than anything, as far as keeping the balances low, but knowing that you can manage your books, your own budget.
Yep.
And so are there any last tips for folks who want to learn about credit? I know you have a lot of educational material, and I appreciate you taking the time today to talk about the credit and building credit and dispelling the myths. So take it away. Any last tips?
Well, tips are you just need to be careful with when you're building it, because if you mess it up, bad credit can stay on your credit report for 7 years. So if you make that 30-day late payment on your credit card, it can stay there for 7 years. So do whatever you can to always make sure you pay your bills on time, and don't overextend yourself. Don't use credit to buy something that you don't have the cash to pay. If you've got cash to pay for it and you want to use that credit card to earn airline miles, that's fine, but then use the cash and pay it off. For more information and for more stuff on credit, my website is really good. I've got a lot of education on there, or I also have educational emails if you want to email me and say, hey, put me on your education campaign. I can put you on a campaign that just sends an email out that's a short little email, but it gives you helpful hints.
Got it. Well, thank you so much, Kelly, for taking the time. Greatly appreciate it. And I'm sure that this information and education will help a lot of different people dispel the myths and figure out what next steps they need to take to accomplish their goals, whether it's home ownership or a new car.
Right. Well, thank you for having me. I've really enjoyed it. As you can tell, I could talk all day long on credit.
It's definitely a complex topic, and I have to say, teaching the homebuyer classes, the credit portion of the curriculum is by far the one where we get inundated with the most questions. And we could, again, talk for hours. Our homebuyer classes are 5 hours, as you know, and we can talk for at least an hour just on credit. And even then, the questions will linger. And so it's good for us to continue the conversation and dispel those myths and continue educating the community. So I appreciate your time.
Thank you.
Thank you. Have a good day.
Bye.
Bye.